Guys, last year was a tough year in the market. The market fell down a lot. And even though I don't think we got to the point where we need to get to, I've been through crashes and I've seen people do ridiculous things. What ridiculous things those might mean? Let me give you a story. I've told this story before. Back in 05 and 06, two friends of mine had just started in the workforce and they said, Paul, we want to save for retirement. What do you think? So I sat them down, go through a history of stock market. And I said, guys, if the stock market fell in half, what would you do? And I remember it like it was yesterday. The wife looked at me and said, we'd buy more, right? I said, exactly. Wonderful. You have the right mindset. Fast forward 2 or 3 years. The market's crashing. The market went from a high of 1,500 in the S&P, got as low as 666. I don't remember exactly when it was, but in the middle of the crash, I got an email from the wife. Paul, what is going on here? What are you doing? And I wrote back. If you remember, when we asked this question, we said we'd buy more. She wrote back, you're buying more? That's what we discussed. And then she wrote back, I'm just worried about everything going to zero. And I just went, but guess what? As time went on, I learned more and more that this is a very, very, very common thing amongst investors. And I get it completely. I remember feeling that way back in 01 and 02. I remember feeling exactly that way because I didn't understand the history of stocks. And for the market to go to zero, what has to happen? For the entire market to go to zero, trust me when I say it won't matter what's in your 401k or your whatever's in your bank account, it will absolutely be useless. And for all you crypto people who think you'll save the world with that, no, it won't. What will matter is how much land, how many guns, and how much food do you have. That's what would matter. So guess what? It's not going to happen. It's absolutely not going to happen. But fear is the big thing, and we are here to be the calming force in your mind. I've said this before 1,000 times in this channel. At some point in the future, we will be the people saying it's a great time to buy and stocks will go lower and people say it's still going lower. I know that's an even better time to buy. You have to look at history. We've had terrorist attacks. We've had assassinations. We've had world wars. We've had depression. We've had recessions. We had a global shutdown. We've had internal terrorist attacks. We've had everything across the gamut happen. And guess what happens to stocks over the long run? GDP goes up. Stocks over the long run go up. When have they fallen? They've always done poorly when one thing has happened, when there's been massive overvaluation. That's it. Whenever you see massive overvaluation in history, you saw very poor returns for the next 10 or 15 years, sometimes even longer than that. But we've never had a rolling 20-year period in stocks where stocks have been down. That doesn't mean it won't happen, but we've never had that happen to date. This is data going back to 1871, according to Shiller in his index in the S&P equivalent. Does that mean it won't happen? Again, that doesn't mean it won't happen because in 06 and 07, we'd never seen the U.S. see an overall U.S. housing price decrease, but it happened because things got massively overvalued. You can blame anything in the world you want on anything, but at the end of the day, valuations drive long-term results, long-term performance in the market. And it makes perfect sense. If you overpay for something, you're going to get less returns. It's that simple. Every investment is the present value of all future cash flow. And that cash flow is going to occur no matter where the stock price is. So the question you have to ask yourself is, are you overpaying or underpaying for free cash flow? That's what matters. But what makes me sad today is that the market isn't crashing. And I know that sounds sadistic and it might sound crazy, but it's true. And you as an investor, unless you're imminently going to retire and need that cash, you should be hoping for a market crash. If you're going to retire very soon, you don't want a market crash, but you should be aware of where we stand in terms of valuations. And valuations can be overpriced for a very long period of time. It has happened not many times, but we're currently in the longest period of overvaluation going back to 1929. And let me show you that data right now. So guys, I created this Excel sheet and every day in our software, I report the current stock market to GDP ratio as well as the percent over or undervalued. This is going back to 1929 on the S&P and the S&P equivalents because I think the S&P, the official S&P 500 started in 1957. But we're currently at 72.8% overvalued. But last year, 2 years ago, we were at 103%. And then when the market crashed last year, we got as low as 50%. Now, what changes this metric? Two things, GDP value and S&P value. These two things drive this value. So as GDP goes up and S&P goes down, it'll make this value much, much better. Just remember that. A multi-bagger is a company that's gone up several times. A 10-bagger would be 10x, a 100-bagger would be 100x. We have read a book recently about finding multi-baggers, and a lot of great value investors will tell you that the best way to do well in investing is to find great companies that can grow and become those huge multi-baggers. So how do you find them? Well, join us for our webinar next Wednesday, June 14th at 1 p.m. Eastern Time. We're going to go over this entire process on how to find appropriate multi-baggers and how to take advantage of them. You won't want to miss this. Come check it out next Wednesday. Sign up at the link below next Wednesday, June 14th, 1 p.m. See you there. So the key is this. Anything in red is overvalued, but anything that's filled in red, the cell is red, is over 30% overvalued. We've been that way since 2017. This is the longest stretch, I believe, of over 30% overvalued. Look at 2000, the bubble of 2000. We're currently higher than the peak level in March of 2000, 56.6% overvalued. Now again, there are going to be people out there who say, well, that metric doesn't matter anymore because of blah, 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 blah. I call BS. And their comment is, Paul, companies are much more profitable today as a percentage, et cetera. And I'm like, fine, then let's go to the 10-year cyclically adjusted PE ratio. What that does is it takes all the earnings of the last 10 years, brings it to today on an average using inflation, and divides the market price by that. If the profitability of companies is so much higher and makes this skewed, that should be a much lower percentage compared to history. But let's go check it out right now. The current Shiller PE ratio is exactly 30 today. This goes back to 1871. This was the Great Depression, the big crash. We're exactly there right now. This was the dot-com bubble, and this was last year. The historical average is 17. If we're at 30 and the historical average is 17, that's overvalued by 76%. Overvalued according to that metric. Our current metric is 73%. So again, if you say to me, Paul, but companies are more profitable, if they're more profitable, then this should be much lower. Because this is based on earnings. This is based on the profitability of the company. But this is still showing a more overvalued metric than this one. And that's why I want a stock crash. Because guys, look at this. 1930, that was a peak. Let's go back to the very beginning of this metric, and let's go and see where the market was in 1930. The next 10-year, this column G is the next 10-year returns, negative 3.9%. Okay, let's pick another date. Right here, 1966. The 24 was the metric. So we go to 1966 right here. We were overvalued by about 30%. Look at the next 10-year returns. Negative, 0%, etc. Okay, let's go to 1982, right here. 1982, we were 65% undervalued. Look at the next 10 years. 14.1% return. Guys, that's incredible. Look at that difference. Let's go to 2000. 2000, we hit a peak here. Look at the next 10-year returns. Negative 2.6. Look at 2000. This includes dividends, guys. It's no coincidence. It makes perfect sense. The more you pay for a stream of cash flow, the less return you're going to make. That's just it. Your goal is to buy a future stream of cash flows as cheap as possible. But you never know when the cheapest possible point will be. Look at 1982. Look how low the value was. But guess what? It got as low as 65% undervalued. Guess what? In 1977, it was 47% undervalued. The market was at 99. The S&P was at 99. So it went to 109 by 1982. 5 years later, and better undervalued. You'd be like, Paul, this thing doesn't work. Look, it's been undervalued for 5 years, and it still hasn't gone up. But guess what happened? Eventually, when value kicked in, everybody realized it, the market skyrocketed. And over the next 20 years, it went up a matter of 14 times. You've got to be patient because you don't know when things are going to turn. And right now, we've been stuck in an overvalued market. I want to get to the point where I'm being criticized in this channel for saying everything is a good deal, Paul. You always say it does, and my stocks keep the same or they go lower. That's the problem with being a value investor. The problem with being a value investor is you're always going to be perceived to be wrong. Because when stocks are flying high and there's a lot of hype, like AI and NVIDIA, and you're saying avoid it, you're going to be looked at as wrong. Go back to 2 years ago. We were calling Cathie Wood an idiot, all these EV companies dumb, cannabis dumb. Everybody's like, you don't get it, you're an idiot. Now, crickets. Now it's like, no, you don't get AI, Paul, you're an idiot. Okay, sounds good. The next one will be something else. And eventually it'll become like it was when stocks are undervalued. Paul, you don't get it. Stocks are nowhere to be. I'm fine with that because at the end of the day, I want to be happy. The people criticize me for not making money in the previous 5 years to 2020. I sit there and go, boy, I've done pretty well since then, as people have sit there and criticized me on that one. I don't hear those people talking anymore. That's my key. You have to be okay being wrong because at the end of the day, what's bigger, your bank account or your ego? That's a shout out to Danny Johnson, who Tim loves. And she made that, when he told me that, I thought it was a brilliant comment. What's bigger, your ego or your bank account? You've got to decide on that one. And trust me, guys, I battle with that all the time. Because whenever I tell people, remember EV, remember this? Paul, AI is different. Boy, it's weird because when EV was happening, EV was different. Now it's not anymore, or it's not as much. The more you're different in terms of your fundamentals and inner peace about looking at stocks and understanding them as a stream of cash flow, the better you will do. I've been screaming that crypto is insane. People still tell me I'm wrong on that one, but nobody's been able to give me a fundamental reason besides it will change the world. The internet changed the world. Go back and look how many internet companies went to zero back in 2000. And a very, very few made it. And the really successful ones started afterwards, except for Amazon. Guys, to me, it's just obvious as day. But sometimes it takes a long time. And this has been a long, long time. The longest ever stretch of over 30% overvalued. Let's look right here. These are the returns when the stock market in history has been at these levels. 30, 40, and 50% overvalued or more, the following 10 years were all negative. Guys, look at that. All negative. And this occurred 49 times, 37, and 37 times. All of them are negative. Okay. When they're undervalued or evenly valued, look at their returns. 10.9, 9.3, and the average is 6.6. The more and more undervalued they are, the better the returns. Think about that, guys. Just look at that. Just look at that. The average, this doesn't include dividends either, by the way. This does not include dividends. The market has to crash for us to get rid of all the idiots out there who believe in crypto, who believe that AI is any price necessary to pay for AI. And the second AI is mentioned, the stock goes to the roof. This sounds like every bubble I've ever heard of in history. But again, you guys are going to come to me, or not you guys, but the people who are watching the channel will support me. But all the haters out there will say, you don't get it. This is why you haven't made money. Sorry to say, but for the last 2 years, it's been pretty effing good for me. Why? Because all the other idiots have lost 80, 90, 100% of their money on those stupid stocks. While I've sat there, been selling call options and cash secured puts on my assets to get more money. Guys, if you like this, subscribe to the channel and share this with somebody else who needs to hear this, because a stock market crash is what you want to have happen. Thank you for your time.